Have you ever wanted to invest in dozens, hundreds, or even thousands of assets without having to buy each one individually? That's exactly what an ETF can help you do. ETFs have become one of the most popular investment vehicles in the world because they offer diversification, simplicity, and often lower costs. But like any investment, they still come with risks. So let's start with the basics. ETF stands for Exchange Traded Fund. An ETF is a fund that holds a collection of investments. Instead of buying one company, you buy units in the ETF. The ETF then owns the underlying assets on behalf of investors. These assets might include shares, bonds, property investments, commodities such as gold or silver, cryptocurrency-related investments, or a combination of different asset types. Think of an ETF like a basket. When you buy one unit of the ETF, you are buying a small piece of everything inside that basket. Building a diversified portfolio can be difficult. If you wanted to own 100 different companies, you would normally need to buy 100 separate investments. That takes time, research, and often a lot of money. ETFs were created to make diversification easier. A single ETF may hold dozens, hundreds, or even thousands of investments. This allows investors to spread risk across many assets with a single purchase. Imagine you want exposure to the largest companies in the United States. You could buy those companies one by one, or you could buy an ETF that already owns many of them. If those companies grow over time, the ETF may increase in value. If some companies struggle, others may perform better and help offset the impact. This is one of the reasons ETFs have become so popular. Many ETFs trade on stock exchanges, just like shares. This means investors can usually buy and sell ETFs through brokerage platforms. Examples may include Robinhood, Sharesies, Hatch, Interactive Brokers, or other brokers available in your country. Some ETF providers also allow investors to invest directly with them. For example, Vanguard offers direct investment options in some countries. The options available depend on where you live, as investment platforms and regulations vary between countries. Whether you invest through a broker or directly with a provider, the main idea remains the same. You are investing in a fund that owns a collection of assets on your behalf. There are several reasons investors use ETFs. First, diversification. A single ETF may hold many investments, reducing the impact of one company performing poorly. Second, simplicity. Instead of researching every investment yourself, you can gain broad exposure through one fund. Third, lower costs. Many ETFs have lower fees than actively managed funds. And fourth, accessibility. Many ETFs can be purchased through standard investing platforms used by everyday investors. Not all ETFs simply track a stock market index. Some ETFs are designed to help manage a portfolio's risk profile. Let's look at a simple example. Imagine you want a portfolio that is 50% growth assets and 50% conservative assets. You invest $10,000. Initially, your portfolio contains $5,000 in growth assets and $5,000 in conservative assets. Everything is balanced, but markets don't stand still. Let's say the growth assets increase in value to $7,000, while the conservative assets remain at $5,000. Your portfolio is now worth $12,000. But the balance has changed. Instead of being 50% growth and 50% conservative, the portfolio is now approximately 58% growth assets and 42% conservative assets. Without doing anything, your portfolio has become riskier than you originally intended. Some portfolio ETFs automatically address this issue. They may sell a portion of the growth assets and use the proceeds to purchase more conservative assets. This process is called rebalancing. The goal is to bring the portfolio back closer to its original target of 50% growth assets and 50% conservative assets. This helps investors maintain their chosen level of risk without constantly monitoring and adjusting their portfolio. Although ETFs can reduce some risks, they cannot eliminate risk completely. The first risk is market risk. If the overall market falls, many ETFs will fall as well. The second risk is concentration risk. Some ETFs may appear diversified, but are heavily weighted toward a small number of companies or sectors. The third risk is sector risk. Some ETFs focus on industries such as technology, healthcare, mining, energy, or crypto-related investments. These sectors can experience both large gains and significant losses. The fourth risk is liquidity risk. Most large ETFs are easy to buy and sell. However, smaller or specialized ETFs may have fewer buyers and sellers, making them harder to trade during volatile markets. Many ETFs are passive. This means they follow a set index or predefined rules. The ETF does not try to pick winning investments. It simply follows the index. Other ETFs are actively managed. Professional fund managers decide what to buy and sell in an attempt to outperform the market. Passive ETFs often have lower fees. Active ETFs often have higher fees. When you buy an ETF, you generally own both the winners and the losers inside the fund. You may not achieve the spectacular returns of selecting the perfect company, but you also reduce the risk of choosing the wrong one. For many investors, that is a worthwhile trade-off. Key takeaways. An ETF is a fund that holds a collection of investments. Those investments may include shares, bonds, property, commodities, crypto-related investments, or a mixture of different assets. Many ETFs trade on stock exchanges, while some providers allow direct investment. ETFs can offer diversification, simplicity, lower costs, and accessibility. Some ETFs can also automatically rebalance portfolios to help maintain a chosen risk profile. But ETFs still carry risks, including market risk, concentration risk, sector risk, and liquidity risk. Understanding both the benefits and the risks can help investors decide whether an ETF is right for them. ETFs have become one of the most popular investment tools available today. For many investors, they provide a simple way to build a diversified portfolio. But before investing, make sure you understand what the ETF owns, how it works, what it costs, and what risks it carries. This video is for general educational purposes only and should not be considered financial advice. Always do your own research before making investment decisions.